Welcome to the show. Finance can be messy, but don't worry. We clean it up with facts, fun, and maybe a little sarcasm here. Welcome to the Financial Sandbox. Let's get into it. My guest today is Cindy Pham from legal1031.com. Cindy, that's a really different name. And that, when I first read it, I thought, ooh, that's not like IPX 1031 Exchange or First American 1031 Exchange. Why do you guys call yourself Legal 1031? Sounds scary.
I actually moved over from another qualified intermediary to Legal 1031, but our founders, they have a legal background. We have a lot of attorneys on our team. We have a general counsel and all our processors, our paralegals. Our president and founder, he's an attorney. So we are very heavily attorneyed, a qualified intermediary that has a lot of attorneys there. So They definitely are, they want to dot the I's and cross the T's. So it's Legal 1031.
That's good. That's good. So you're in Houston. And you told me recently that you were in Newport Beach, California, and you were a little jealous about our California weather.
Well, I actually grew up, I went to grade school in the Bay Area, Milpitas High School, Sunnyvale, Milpitas. I lived around that area. And gosh, when I was younger, I didn't appreciate the weather. I was like, it's so cold in the morning and then it gets hot. I'm like, you don't even know what to wear. And now I've been in Houston for, I don't know, 30, almost 40 years. And I'm just kind of like, what was I thinking?
So now that you were in Newport Beach recently and you live in Houston, why did you suddenly say, oh my gosh, this is why they're here? What was different? What was immediately different?
The weather. I mean, you don't walk off the plane and where the humidity and the heat just hits you in the face. Although, they said the humidity, keeps us younger, right? So, I'm older than I look. Most people think I'm like a lot younger than I am, but no, I have that. Genetics and the humidity probably helped my skin.
Exactly. Here. That's both of us are blessed with those gifts, those genetic gifts. Hey, so one of the things I want to talk about, and I'm so glad I'm talking to you because Legal 1031 Exchange, legal1031.com, I meet with clients all the time and they want to know the steps, right? And they want to stay in alignment and not fall afoul of the IRS. So I'm going to have a couple of questions for you on kind of the process here. And those are some of the things I want to talk about. So when you start an exchange, what are the 3 top things that you talk to about a client when they start this process? Do you talk about, who are they as the taxpayer? How is the property entitled? What are those top items that you want to learn about when you start that conversation?
Well, I talk about all of those things, but first, when I do speak to a prospect or a new client, I want to know about the property. What kind of property are you selling? And really, I just want to make sure, because the 1031 exchange, CPAs call this a like kind. A like kind, the Treasury regulations on this, it's a like kind property, and like kind is broad to the IRS. So in the tax code, it's a property for trade or business or property for investment. And so, land can be, held for appreciation. Land is considered like kind property. If you've got commercial property, that's, investment property. And if it's a house, and there's a lot of clients that do 1031 exchanges on houses, but they have to be an investment property. So it's got to be a rental. It cannot be their home that they're living in or a second home. And so I kind of go through these. Those are the first questions I ask. So what kind of property are you selling? And then also, is this a property that you're thinking about selling, or is it under contract already? And if it's already under contract yet, well, have they closed on it? So the biggest mistake I get from the clients is that, they realize how much taxes they have to pay and they want to do a 1031 exchange. And when they get to me, like, when did you close? Well, I closed yesterday or 2 weeks ago. And therefore, it's too late to do the 1031 exchange at that
Right.
point. So we
Because they
have to
have
be
to open up
involved.
the account while they're
Yeah,
in escrow. This is
correct.
really, and I often tell a client, hey, before you put this on the market, I want you to talk to Cindy now.
Yeah. So on a forward exchange or a delayed exchange where you're selling one property to buy another, you have to use the qualified intermediary to hold the funds. So think of it as we're a specialized escrow company to hold those funds. So we have to receive those funds before you close. So therefore, we technically have an exchange agreement that agreement assigns that contract over to us as the intermediary where we receive the funds. So if they've closed on the sale, and even if the funds are still in escrow, it's not been wired to them yet, they're in constructive receipt. So we have that's still too late. So we have to be involved before that whole process.
I like what you said, specialized escrow company, because people don't think about the first escrow company that's working the transaction.
Yeah, and that's for an exchange that's the most common exchange. That's called the delayed exchange or the forward exchange. But there are other exchanges as well, which are more complicated. But there's the reverse exchange, improvement exchanges. On those type of exchanges, we hold title to the property, not
Mhm.
just the funds. So that's specifically on a simple exchange. We essentially just hold the funds like a special escrow company that's required.
So you use the word constructive receipt. So tell me what that means so that my audience understands. What does that mean when you take constructive receipt, and how are those funds handled when you get them? What do you do with them?
So let's say you called me today and said, "Hey, Cindy, I want to do a 1031 exchange." So I said, "Great, I can help you." Well, when do you close? Well, we just signed the documents just this morning. Well, did the seller and the buyer both sign the closing documents already? Then and you say yes, but the funds are still are still in escrow. It hasn't been wired to me yet. Well, you're in constructive receipt because you're entitled to the proceeds already.
Right.
The buyer is entitled to the property and you are entitled to the proceeds, right? So therefore, you're in constructive receipts, which is too late for the
So it has to be
1031.
before they close escrow,
Correct,
before both
correct,
parties close, before the new buyer's lender funds, and the title company has the funds,
correct.
is
Because
getting ready.
essentially the exchange documents assigns that contract to us. So essentially now it's legal 1031 exchange as qualified intermediary for her. So now essentially we technically become the seller, and
Right.
we have the right to receive the funds at closing. But if you have the right to receive the funds, it's too late.
Yeah, exactly. I've had those calls where people say, Herb, I talked to you 3 months ago and we didn't know what we were going to do, but we're ready to do our exchange now. Great. Who's your qualified intermediary? And I've had that silence.
I've had clients that spoke to me 3 months ago, and then they are on their way to the title to the escrow office. The title in Texas, title and escrow is the same. They do title and escrow. I'm on the way for the closing, and I forgot to set up the exchange. And so even if and then I've had instances where the buyers already signed the exchange docs but the seller didn't. So at that point, if only it's only closed if both parties signs. If
Correct.
one party signs, it could still be done. Say
Yeah.
that means like get me on the phone, send me what I need. I gotta make a call to my processing team like to get the docs immediately, so it can done pretty last minute.
Right.
But if both parties sign, then it's a
It's
bit too
too late.
late.
Yeah. And it's different here in California because both parties can sign and then the
Mhm.
funds can wind up wiring 3 days later. Right.
Yeah,
So it's a little different here in California. Northern California, we do title and escrow as one company. In Southern California, they're title and escrow. So there's two
yeah,
different companies. So different parts of the country work differently. And so as I have a national audience, people need to sort of understand the steps.
yeah. And also, like in New York, they use closing attorneys. The attorneys have to do the closing. So it's different in certain parts of the states.
Right, right. So when people are closing escrow, then the clock starts, right?
Correct.
So we close today, and 45 days from now is that period of time, that very stressful period of time where a seller who's now a buyer has to identify that property. What documents do you need from that buyer to identify that property? What do you need from them?
So we provide a form called the identification form. We make it easy. So we send a form to the client called the identification form, and so they can list out the properties that they want to identify. There's a couple of rules to identifying, but they would, and the most common rule is the 3 property rule. So they'll select that and list out 3 properties, and then sign it, send it back, and that's considered identified. However, in the Treasury regulations, the identification rules, it's got to be in writing, sent in by midnight of the 45th day to a party related to the transaction that's not disqualified. It's got to be ambiguously described. So I've had instances where, those clients that, no offense to anyone that's listening to this, if you're them, but they don't read their emails. They ignore emails, or they just kind of skip over emails, and so I've had clients where
Last minute client.
Yeah, they're in their exchange, but the agent, the broker, the agent is calling. It's like, today is your last day, but the client is on the slopes skiing in Colorado. And so I've had a client take a piece of a napkin, jot down, I, John Doe, identify this address as my identification property.
Yeah.
It signed it, dated, took an iPhone, snapped a picture, and emailed it to us, a picture of the napkin. So that's a valid identification as well.
Yes, that's a valid identification. But folks, that is not how we want you to do it.
Not the most professional way, way, but it works.
It works. And because there are stories. We could do hours on stories, right?
Yeah.
So when you talk about, there's a 3 property rule, there's a 200% rule, and then there's the crazy 95% rule. Let's not even talk about that. But let's talk. Tell me about the 200% rule in your idea, how that works.
So the 200% rule is you can identify as many properties as you want. So that's going to be 4 properties or more, but the aggregate value of the combined properties cannot be more than double the sales price of what you sold.
Correct.
So 200% of the value of the property that you sold.
And what about the debt? I did an exchange a couple years ago, and the gentleman I was working with, he did an exchange that had 60% loan on it. Mm-hmm. And he called me and said, okay, I'm done with my exchange. Almost. There's a little bit of money left. I bought these 2 properties all cash, and my QI referred me to you and said I have to figure out what to do with the debt, but I paid off the loan already. And so my question to him was, well, did you get a loan on any of those properties?
So it doesn't really. So think of it as this. Let's say you sold a property for, let's say, $1 million. And the debt was $600,000. Okay. So think of an exchange as you're exchanging properties. If I sold for $1 million, I'm trading for another property that's $1 million. And it doesn't matter whether it's an all cash deal or a combination cash and debt. I sold $1 million, I'm trading for another property that's $1 million or more for a full tax deferral. Right. So if you gave me if you and I swapped properties, and you gave me $1 million property and I gave you a $400,000 property, you're like, that's not going to work, right? Right? That's not going to work. So for a full tax deferral, you want to spend all the net equity and have the same or greater debt on the new property.
They have to get that debt. And it was really interesting because throughout it, he kept saying, I paid off the loan. And I said, yes, but in an exchange, you also have to get a loan for the same amount that you came out of the sale with. You have to replace the loan.
So I'm assuming he paid the debt after the property closed.
Yeah, when he closed, at closing, his loan was paid off. So that means he had $400,000 at the QI.
Yeah,
So
so
he's
he needed
buying
to
over a
spend,
million,
yeah, he needed to buy $1 million or more for a full tax deferral.
right?
Yeah.
And get the debt. It took a little bit to explain it, and about 10 seconds of silence when he realized, oh, I have to get a loan. So
Yeah, unless he's got cash to offset the debt.
correct. So he can also put in cash. So when you guys get the funds, do you set up separate escrow accounts or
Correct. Yeah,
so how do you do it?
we segregate all the funds, all the client funds.
And they each go into their own. Is it a separate LLC? Is it a separate escrow account? What are they called, and how do we? Because the qualified intermediary space is not really a regulated space, right?
Yeah, so what we do is that we have it's in our accounts, our bank accounts, and we have sub accounts for every single client, so we don't commingle their funds.
Right,
Yeah.
right. So I'm going to switch gears here a little bit. I had a situation recently where family is selling a handful of businesses, and the son is buying, and the parents want to do a 1031 exchange, but the son is a related party.
Okay.
Why can't you do an exchange with a son as a related party?
Is was the son buying from the parents?
Yes.
So you can sell to anyone you want. Okay. So the
Okay.
son can buy the property from the parents. What you cannot do is that the parents are doing a 1031 exchange. They cannot use their exchange proceeds to buy from a son.
Oh, it's the other way around.
Correct. So you can sell to anyone that you want. You just can't buy from a related party.
Aha.
With the exception, there is an exception. So parents takes their 1031 exchange funds, buys the son's property, and the son uses those proceeds and he does his own separate 1031 exchange to buy another property.
Right. Right.
That's kind of like a tax avoidance kind of issue. Because not that I'm saying anyone is playing the family game, but like for instance, I'm going to do a 1031 exchange on my property. I'm going to use my proceeds to buy my mom's property. Okay.
Mhm.
And so my mom's going to sell me her property, which probably I would have inherited anyway, right?
Right.
Um, but once I close and take title to my mom's property and under the table, hey mom, that money, can you give it back to me? Right?
They
Because
took
my mom would do anything for me. So she's gonna now I own the property. My mom under the table gave me the money back. So that's why there's the related world property. So the exception is that my mom takes the funds that I paid her, she does her own 1031 exchange to buy another property. So therefore now the money's no longer available to me.
Right. Right. Exactly. Just clarifying how that money has to be separated.
Yeah.
So there are all kinds of ways to hold title. And I had someone this week say, we have it in an LLC and we're going to put it in a new LLC.
Okay.
So let's talk about when you sell a property, you sell it in Herb LLC and you have to buy in Herb LLC. We can change it afterwards, but we can't do it in between. Is that correct?
Not exactly. It just depends on what Herb LLC is. Is it a disregarded LLC or a regarded LLC? So a regarded LLC files its own taxes. So it could be an S corp. It could be taxed as a partnership. It files its own separate taxes from you personally.
Right.
Okay. A disregarded LLC is a single member LLC, and you file taxes for the LLC through your personal taxes. So somewhere in your when you file taxes personally, it's going to be a schedule on one of the schedules on your personal taxes. So essentially, Herb is the taxpayer, but you hold title under the LLC.
Correct.
Okay, so if it is a disregarded LLC, it could go from Herb to Herb LLC, and then you sell that and buy into another, you create a Herb 2 LLC or Herb 3 LLC. And as long as all those LLCs are disregarded LLCs, it's okay, because essentially you're still the taxpayer. So the same taxpayer that sells needs to be the same taxpayer that buys. Now,
Exactly. Yeah, that's the key.
yeah, so if Herb LLC is a regarded LLC, then it needs to stay as a Herb LLC sells, Herb LLC buys. Same thing as a partnership or corporation. Um, Same taxpayer that sells needs to be a same taxpayer that buys. And also, that's the same with a revocable trust. A revocable trust revokes back to you as an individual. So it could go from Herb to the revocable trust to Herb disregarded LLC. So it all goes, you're still at the top of the pyramid as the taxpayer.
Correct. So what about what is called a drop and swap?
A drop and swap?
Yeah.
Oh, I hate to talk about that because you're in California.
I'm bringing you the hard questions.
Well, so so a drop and swap. So when you've got partners, let's say you and I become partners. We've owned a property for 5 years, it's going to be Herb and Cindy LLC. Yeah, HC LLC owns this property. We've owned this building for 5 years, and after 5 years, you know, Herb, you say, hey, you know what, Cindy, it's a good time to sell, and I really, don't want to be your partner anymore. You talk too much, so I don't want to be your partner. So let's go ahead and sell this and go our separate ways. But we don't want to pay taxes on the capital gains, right? However, you and we own interest in our entity. We own interest in a partnership. We own 50% of HC Properties LLC. That's not owning real property. That's owning interest in a partnership. So that's not considered real property. Okay. If H&C Properties LLC sells and H&C Properties LLC buys, then that could be done because that's the taxpayer. Now, a drop and swap is when it's commonly practiced, but is when you dissolve this partnership.
Mm-hmm.
Okay, you dissolve this partnership and you contribute the ownership from the interest from the partnership to individuals as a tenant in common structure, and
Correct.
then the tenant in common. Well, now going from H&C Properties LLC, properties redeeded to Herb and Cindy, and so now Cindy's going to take her half to do a 1031 exchange, and Herb is going to take his half to do a 1031 exchange. Now, issues that you have to be aware of with that, especially in California, is about the holding period. Okay, so now after we've held the property, we dissolved Herb and Cindy LLC Properties LLC. Now we're going to do a 1031 exchange. When we do a 1031 exchange, we file that with the IRS on a tax form 8824. It's going to ask you, Herb, how long have you owned the property? Well, although H&C Properties have owned this property for 5 years, but Herb has only owned this property for a month,
Right.
or 2 weeks.
Mm-hmm.
And so you cannot flip a property. So Herb, sorry, I keep saying Herb.
Right. People call me Herb. People call me Herb. It's okay.
So did you flip the property, right? So the feds, they're okay with it's common practice. A lot of people do a drop and swap, but the reality is that in the time that you dissolve this partnership and do your 1031 exchange, the more time in between, the better, right? In California, the franchise tax board in California is very strict on that. So generally, what I've seen people in California, the exit strategy is a lot longer. So if they dissolve this partnership and drop into a tick, they're still holding on to this property for a year to 2 years at least before they sell. So you gotta plan out that divorce ahead of time.
That's a good way to put it. Yeah, it's interesting. I had a gentleman who called me yesterday, and he said, I have these 3 properties. I bought them. We remodeled them. We're selling them. And can I do a 1031 exchange? And I said, well, did you buy this for the purpose of a business entity, were you using as a rental, which is part of the rules in the 1031 exchange? He said, oh no, we bought it and flipped it. And I said, well, there you use the word, you flipped it.
Yeah.
And you can't do a 1031 exchange in
Well,
that instance.
essentially, if your intent is to sell, it doesn't qualify. So if you bought the property to fix and sell, it doesn't qualify. Or you bought, developed to sell, it doesn't qualify. Or if you're a builder, buy, build, and sell, it doesn't. If your intent is to sell, that doesn't qualify for a 1031 exchange. It's got to be held for as an investment property.
Exactly. So you mentioned the form 8824. What is that form and what does it do?
That's the tax form that you file to report the 1031 exchange when you do your taxes.
Okay. So it's a very simple, straightforward form.
Tax form, yeah.
Yeah.
And hopefully everyone here, one of the things I always mention to my clients, talk to your CPA. As an intermediary, by the way, I don't have a tax background. My background is also in real estate. I've been doing real estate. I was in commercial real estate since 2001, actually. So almost 24, 25 years.
It's funny when we look back and we're like, wait,
yeah, I'm like, do I see wrinkles? So I've been in so my background is in real estate, commercial real estate, and I've been doing 1031 exchanges in um, this new life of mine. I've been doing it probably about 7, going on 8 years.
Mm-hmm.
And so I'm actually not a qualified tax person, and I'm not an attorney either. So I don't give tax advice. I don't give legal advice. So we help with the process and the guidelines, but it is the CPAs, it's your advisors that give you advice whether you should do a 1031 exchange or not. Sometimes I've got clients in a very gray situation. I would advise them to go back to their CPA to get their CPA's thoughts on whether it qualifies or not.
That's always the case. I have that conversation with people all the time. I have to say, look, I'm not a CPA, right? So what you need to do is call your CPA, sit down, do the numbers, and find out, should I do an exchange, right? Is it worth it for me to do an exchange? What are the costs for me to do an exchange? And am I actually going to have a benefit out of it? And I refer people back to their CPA all the time to go back and get that knowledge. Now we're talking about cost. What does it cost to do an exchange? I know that when you do a reverse exchange, those costs are higher than a forward exchange. Can you talk about both of them and what the differences are?
Yeah, so on a forward exchange, essentially it's really simple. We do these with our eyes closed, right? So essentially I'm just holding the funds, right? And so a cost of a delayed exchange, it ranges, it could be 1250, it could be 1500 as a standard fee that you see around the nation, right? In the Northeast Coast, it's a little bit different just because their closing process is a little bit different. So it depends on the value of the property. But generally, I'll do about 1250 or 1500 depending on where the property is located. Okay. But on a reverse exchange, I just want to explain the reverse exchange first. Okay.
Sure.
Because it's more complicated. Essentially, a reverse exchange is when you have the replacement property, the property that you're buying, you have to buy this property first. That seller is not going to wait for you to sell your relinquished property. So it's just a deal that you need to buy first. Okay. Now, if you have your property, your relinquished property, and you buy this replacement property first, then you own 2 properties. That's not an exchange, right? That's not an exchange. So in order to structure this reverse exchange, we actually become, instead of a qualified intermediary, we're a qualified accommodator of title. So our company creates an LLC, an entity as well. We use our entity, our LLC, to purchase the replacement property, to take title to that property. So we hold the title to that property. Instead of holding money, I'm holding title. So therefore, I own title to this property and you still own your relinquished property. So therefore, you don't own 2 properties at once.
So clarifying that, legal 1031 will buy the property. obviously using the buyer's money, but
Correct.
you guys own the property in a separate LLC. And now the seller, the buyer who bought that property, now has to go off and sell. They bought an apartment building, so now they need to go off and sell their other apartment building to make
Yes.
that exchange happen. And what's the timelines in that?
It's still 180 days. And I do want to clarify that you did mention it. Like, we don't use our money to buy the property.
Exactly.
We gotta use your money to buy the property, right? So if it's a cash deal, great. That's a simple deal. But if there's a lender involved, if you need a lender for the property, then it does, because we are the entity that is buying the property, it's the entity that needs to be on the loan docs, right?
Okay.
And we structure this 1031 exchange, reverse exchange, just for your sake, for the 1031 exchange. We're not taking the liability. So the loan, it needs to be a non-recourse loan to us, to legal 1031. Okay,
Correct.
so the lender has to be okay with that. So you have to have a good relationship with a lender that understands a reverse 1031 exchange to do that. Okay, so um, from the time, let's say that gets all settled, but from the time that we close on the replacement property, you have 45 days to identify what you're going to sell, and you need to close on the relinquished property within the 180 days.
The
And then
timelines are the same.
the timelines are the same. And then once we close on that property, then the LLC that we have, we can transfer the ownership of the LLC. So you now own this LLC as your disregarded property, or your disregarded LLC, which owns the property. Or there's another option, if you want the property redeeded back to you as a taxpayer, we can do that. So either or, but a lot of people like to take the entity. We'll ask you what are your preference on the entity names,
Right.
and most will take the entity name.
So this is more complicated. It's more work, which means the cost on it is higher.
Yeah, it's probably ranging from $8,000 to $10,000, depending on how complex it is, if there's a lender involved in it.
So that's where a forward exchange, about $1,500, it sounds like, depending on how many properties you're buying, 1, 2, or 3, or 4, et cetera,
Yeah,
et cetera. Those costs are a lot less.
yeah. And also, if this is a commercial property, we want that phase one. We need to make sure we need all those as well.
Right. So all the inspections, everything
Yeah,
has
the
to be done.
inspections, yeah.
Yeah.
And similarly, with a improvement exchange, we have to take title to the property as well. On the improvement exchange, you are selling a property and buying the land and then building the building. But once we use your exchange proceeds to buy the land, well, we can't use the remaining proceeds to improve something that you already own. So therefore, we have to take title to the land. So the remaining exchange proceeds will go towards the improvements. And the timeline is still the same. From the time you sold your relinquished property, you've got 45 days to identify what you're going to buy and what you're going to build, the improvements on it. And you have to complete the exchange within 180 days. Now, at the 180 days, you don't have to have a whole building complete. You just want to spend all the exchange proceeds.
Aha. So let's do that again, just to clarify for the audience, because they're gonna hit rewind, right?
Okay.
So you're saying that I can buy a property and do an improvement exchange. So I'm buying a lot that has plans for 3 houses, or 3 houses are in the middle of construction, and I'm buying it from someone else. What's the process there? Am I really buying the land? Am I buying the properties? And I've got X amount of dollars. I've got $1 million in my exchange. Do I have to spend that whole $1 million on the construction portion in the 180 days?
So essentially, let's say you've got $1 million and you've got a lot, you're buying a piece of land that costs you $300,000. And then you're going to work on to build a building on that land. Once you've closed on the building, you want to build a building. So the remaining $700,000 goes into the improvements. So you do identify the land and the improvements that you're going to make on that. And so we'll have a construction draw. We take title to the land, and then we'll have a construction draw agreement. And so as your contractors, your vendors are building out on the land, or it's soft cost to your architectural cost for that. The
Sure.
invoice goes to us and we pay out those vendors. And so let's say at 180 days, you've got, the plans are ready, your foundation, your plumbing's there, and the rest of the building is not done, or partial building is done, it's at 180 days, or you've already used up the 700,000, then your exchange is done. Then you just continue building your building with your own funds.
So that's really interesting, because people do come to me and say, well, can I build a property with the funds from my exchange? Can I do a construction project? And that's the clearest explanation I've heard from that. So thank you, because people always ask that question.
There's a sweet spot for improvement exchanges because you want to spend all the money. So if let's say you sold a $5 million property. Okay, so the question is, and the land value of the property was, let's say, $1 million. The land was $1 million. The question is, can you spend $4 million can you close on the land? Yeah. So there's a sweet spot. But if I go more complicated, more strategical, we can make this an improvement and a forward exchange, right? A combination exchange. So you're going to buy the land for $1 million, and you're going to do these improvements. That's going to be around this much, but also you're going to identify other properties that you're going to buy.
Mm-hmm.
So if you can't spend the $4 million, the 180 days, well, you can also use the remaining proceeds to buy other property as well.
Oh, okay. So I can buy other property as well.
Yeah, you can identify DSTs as backups.
Right, exactly. And that you've just led me to my next question about the Delaware statutory trust. A lot of my clients are those individuals and families that have owned property for a long time, and they want to transition out of ownership. Two questions. First, someone uses the DST as a backup plan, right? And they've got a $2 million exchange. They found a building for $1.2 million. And they found another building for $2 million, but they're not certain what they're going to do. So they're going to take the $800,000 and they're going to identify $800,000 worth of DSTs as a replacement, just in case that $2 million building doesn't work. They've got a plan to buy the smaller building and then use the rest for DSTs. How complicated is that paperwork for you? And what do you need?
It's not complicated at all. Yeah. So the DSTs, basically, it's like an exception to the IRS to be treated as like kind. So on your identification form, you're going to identify the building and also the DSTs that you want to specifically select. You can't just generalize and say, hey, I'm gonna put this address as my building and then also a DST. It's got to be a specific asset in a DST.
Right. We have a variety of Delaware statutory trust options. So we have necessity retail portfolios, senior living portfolios, self-storage, family class A. So we always identify a percentage of that equity of that DST, and then we send you a copy of the identification of the DST that gives you the percentage ownership and all of that information, so that we attach to the form to make sure that you have everything that you need.
And then it's a very simple process. It's just like buying another property. So we have the exchange documents for the replacement property for the building that you're going to buy, and then we have the exchange documents for the DSTs that you're going to buy as well. So it's very simple.
Do you see more people utilizing a DST option today than, let's say, 5 years ago or 10 years ago? Where do you see the world going in 1031 exchange, especially working with baby boomers and
yeah, so generally my clients that come to me, when they're usually the profile of a DST client, when they come to me, like, I don't know what I want to buy, and I don't know about owning more real estate. I don't want to manage. I want to wind down. I want to retire. I don't want those calls, those property management calls. And so generally it's those clients that are kind of wanting to wind down from owning assets and being active. They want to preserve their assets, and so then they'll go with the DST.
Right. They want to spend more time with the grandkids.
Yeah.
Travel.
So the younger profile client, generally sometimes they're more, they want a higher return, they're more riskier. But generally what I've seen in a DST, they're more stabilized. And so, it's more about preserving their assets and getting checks in the mail, than like the riskier, investment, whether is this
Grow.
gonna grow as aggressively as they've been sold as.
Right, 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 right. So you enjoyed this. I really, I see that when you talk about it, you like the complexity, and it sounds like you really enjoy this on a daily basis because it's never a dull
I
moment.
Yeah, so it's funny because I went from doing deals. I was a commercial broker. Like I was a retail commercial broker, and so I went from being a deal junkie to explaining this like all day long, and you're just kind of like, oh my gosh, the switch from doing deals to talking about tax. Oh my God, how boring is this? But I have just learned to embrace this new career. Well, it's been 8 years, but this whole industry, because it's an industry that I'm the good guy. I'm helping you. I'm helping our clients. And the fun part of it is it can be very strategic. The 1031 exchange can be very strategic on how you structure a 1031 exchange deal. Um, I teach a lot of classes. I teach a lot of CE classes to realtors and brokers. And I always joke around, I'm probably going to be the most animated, most exciting like person that like you can it won't be boring. They usually come out with like their head just kind of explodes like, oh my gosh, that was a lot of information. So
Right.
I can go on forever.
Yeah, I teach a class as well. You do it from continuing ed. I teach a class to agents on how to grow their real estate practice using 1031 exchange. Right?
Yeah.
Go talk to those clients that have that 2-unit, 6-unit, 10-unit property that they've had for 15, 20 years. What do they want to do? Right? Where do they want to be 5 years from now? Do they still want to be managing it? So it is, I get it. That at first they walk in and but by the time they're done, their mind is blown.
Well, a lot of people know, I do get those calls a lot. A lot of people are not informed. They don't know about a 1031 exchange. And so those calls that they call me and, oh, I just heard about this and I closed already, and they get upset because no one told them about a 1031 exchange. It's like, how come the first person they blame is their agents or the brokers, and then they blame the escrow officers? Like, how come no one told me? But one of the things I kind of talk about in my classes go, why do you want to do a 1031 exchange? First, who wants to pay for taxes,
Right,
right? No one
right,
wants to pay for taxes. And
right.
and two, you've got more buying power. So let's say I've got $1 million sale, and I'm going to be taxed. You've got the depreciation recapture tax, you've got your capital gain taxes, which is 15 or 20%. Then you have the net investment income tax, and then the state taxes. Let's say conservatively I'm going to be paying 35%. That's $350,000 going into tax dollars. So you net out 650. Well, I could buy a property at reinvest 650,000, or I can reinvest $1 million.
Exactly.
So you've got more buying power by doing a 1031 exchange. And if you want to leverage that, okay, so let's say you leverage that and put that as a down payment, and you as you're growing your real estate empire. Well, let's say you do a 75% loan to value on this property, and you did it with after tax dollars at 650,000. Your buying power is 2.6 million. But if you did a 1031 exchange on a million, that means you can buy something that potentially is 4 million. You've got
Exactly.
more property. You got to look at the return on investment. And even so, like I always joke about this, 'cause I say California all the time. So this is a federal tax code. You can buy and sell anywhere in the United States, right?
Right.
So I actually use this example. It's like you're going to sell in California for $1 million, pay the taxes, you net out, and you buy a $650,000 property in Texas. Or you could buy like $1 million property, a $650,000 property in Texas versus a million. That's a big that's a big difference in the asset, right? So look at the return on investment on that. The rent that you would get on a $650,000 asset versus a million, right? So you've got more buying power.
Right, right. This is so smart. It's so great to have you on because you've done the commercial sales and you understand 1031 exchange. We're so simpatico here because this is what I talk to people about all the time, is having is really looking at the big picture.
Yeah, and then I also bring up that another reason for a 1031 exchange is for the step up in basis. It's the building that generational wealth, because if with the 1031 exchange, you can always keep, once you sell a property, keeps on the DST cycle sells, is closes, you reinvest to another DST or another property. So you can always continue to swap until you drop.
Correct. That's our term.
Right?
Swap until you drop.
You swap into your drop, and then I always make my joke. I go, that Uncle Sam is in love with you. He's gonna follow you from property to property to property. But once you die, he's so sad he goes away, right? And so your heirs, let's say your children, inherit the property. Well, Uncle Sam is in love with you, not your child, so he goes away. So your heirs get a step up in basis. Their basis resets from the time they inherit the property, and it starts over from there, and then they earn their own Uncle Sam stalker, right? But with you, the taxes go away. So in your lifetime, you're not paying for the capital gain taxes, and your heirs don't inherit the taxes that you've incurred during your lifetime too.
Exactly. Well, hey, I'm so glad to have had you on the show. So at the end of my show, I like to ask kind of these unique questions. And I see you, when I talk to you, you feel that you're a superhero to your clients. If you had to choose a superhero when you're looking at animated cartoon characters and all the other superheroes, who do you resemble most?
I'm gonna say Superwoman.
And why? Tell me why.
I'm not fighting the bad people. It's just more of saving. It's not about like catching the bad people, but just saving the good people.
Exactly.
And it would be cool to have a lasso. I'm in Texas. I'm in Texas. I got. Oh yeah, Wonder Woman. Did I say Superwoman? I meant Wonder Woman. I'm thinking Wonder Woman. I want the boots and the lasso because I'm in Texas. I'm a Texan, y'all.
That's great. Well, folks, that's a wrap. Don't forget to like, subscribe, and stay tuned for more raw, real financial talk in the Sandbox. Cindy, thanks so much for coming on.
Thank you so much for having me. I enjoyed it.
This was so much fun. All right. Well, hey, have a great day. I look forward to seeing you soon.